Welcome to the Deep Dive. Today, we're plunging into a company that's, well, really at a fascinating crossroads. Arcutis Biotherapeutics. You'll find them on NASDAQ under ARQT. They've got this innovative product really aiming to redefine standard medical care. And they're showing explosive growth right now, beating expectations.
Yeah, the numbers are pretty eye-popping.
But here's the tension. The market opinion is fiercely divided. Some see just immense opportunity here, while others are frankly betting heavily against its future.
Right. It's a classic battleground stock.
So the big question for you listening in is which narrative, the bull or the bear, is ultimately going to prove more prescient?
That's what we're here to unpack.
This deep dive is based on our comprehensive stock analysis as of August 8th, 2025. Arcutis, their mission is really to disrupt the dermatology market,
Right.
specifically challenging the long-standing use of topical steroids.
A huge entrenched market.
Exactly. And speaking of timely info, Arcutis just released its Q2 2025 earnings report. This was after market close on August 6th.
Very recent, yeah.
And they delivered an EPS of -$0.13 on revenue of $81.5 million. That significantly beat Wall Street's consensus forecast, which was around -17 EPS.
So strong beat. Shows real momentum.
It really does. And it's exactly this kind of up-to-the-minute analysis we pride ourselves on delivering. For our members, we're often covering earnings for stocks literally within minutes of their release.
Being on top of it.
So, for this deep dive into Arcutis, we've structured our journey into two main parts. Part one is up first. We'll examine the core business, the leadership guiding it, and its financial health.
The fundamentals.
Right. Then in part two, we'll shift our lens to those external forces, how the market perceives Arcutis, who owns the stock, the significant risks involved, and finally, we'll bring it all together in a synthesized conclusion.
Sounds good.
Our mission here is to give you, our listener, a shortcut to being truly well-informed about this fascinating company.
Let's dive in.
Okay, let's begin with Chapter 1, Business Analysis.
Mm-hmm.
The mission to disrupt topical steroids. So for decades, the go-to treatment for inflammatory skin diseases, things like psoriasis or eczema, has been topical steroids.
Absolutely. Standard of care for a long time.
But while they work, they have these well-documented side effects, right?
Yeah.
Like skin thinning, systemic absorption, things that really limit how long you can use them safely.
Yeah, long-term use is a major issue.
And the surprising part, I think, is that over 2/3 of this massive market still relies on these legacy treatments. It just feels like a paradigm ripe for disruption.
Exactly. And that's where Arcutis comes in. They aren't just, another dermatology company. They're a commercial stage medical dermatology company with a very clear vision to fundamentally shift that paradigm.
Okay.
Their cornerstone product is ZORYVE. That's the brand name for roflumilast. It's a highly potent and selective topical PDE4 inhibitor.
Right, PDE4 inhibitor. So it works by blocking a specific enzyme to reduce inflammation.
Precisely. Tackles the problem at a molecular level right there on the skin. Management actually likes to call ZORYVE a Swiss Army knife for dermatology because it's so versatile.
A Swiss Army knife. I like that. It certainly highlights the versatility. But how does that actually translate into, concrete market share and revenue against treatments that are maybe more established or specialized?
That's the key question.
Let's dive into their product portfolio and revenue streams. We're talking multiple formulations of ZORYVE, right?
Correct. First, there's EORYVE Cream 0.3%. This one's approved for plaque psoriasis in patients aged 6 and up. It's designed for once-daily chronic use, even in sensitive areas.
Okay, psoriasis. Well,
Then you have ZORYVE Foam 0.3%. This is approved for seborrheic dermatitis for ages 9 and up. And this is a big deal because it's the first new mechanism of action for sebderm in over 2 decades.
wow, 20 years.
Yeah, and it's also approved for scalp and body psoriasis. That addresses a huge unmet need. Over half of psoriasis patients have scalp involvement, which can be really tough to treat.
Makes sense. And there's one more formulation.
Yes, ZOYVE Cream 0.15%. This one is for mild to moderate atopic dermatitis, again for adults and children 6 and up. It offers that much-needed steroid-free option for long-term use without the usual limitations you get with steroids.
So steroid-free is the big theme here.
Yeah.
How does this translate into revenue?
Well, Arcutis' revenue streams reflect this multi-pronged approach. The main driver is net product revenue from ZORYVE sales in the U.S. and Canada.
Right.
In 2024, the foam and the 0.15% cream contributed significantly, and the original 0.3% cream That alone saw, get this, $55.9 million in year-over-year growth.
Impressive growth.
Huge growth. And
Yeah.
beyond direct sales, they have what they call other revenue from some smart licensing agreements. For example, Sato Pharma for Japan, that brought in $25 million in 2024. And Huadong Medicine for Greater China added another $5 million.
Okay, so diversifying income streams.
Exactly. It's crucial for supporting their ongoing growth in R&D.
They've definitely made a mark quickly. Arcutis actually claims ZORYVE is the #1 prescribed branded non-steroidal topical.
That's a strong claim, and it seems backed by the prescription data so far.
And their target market is just immense. We're talking about 17 million U.S. patients across their approved indications.
Massive potential pool of patients.
And their sales strategy seems clever too. They have a targeted specialty sales force hitting the dermatologists, but also a strategic co-promotion agreement with Kowa Pharmaceuticals.
Right, to reach the primary care practitioners and pediatricians, expanding their reach beyond just specialists.
So pulling it all together, what's the core primary value proposition they're offering? What cuts through all this complexity?
I think the primary value prop is elegant in its simplicity, really. It's a single, effective, well-tolerated, and crucially non-steroidal treatment for multiple inflammatory skin conditions.
Okay.
And it can be used long-term on any body part. This directly tackles all those limitations of traditional steroids we talked about, skin
Yeah.
atrophy, systemic absorption, usage restrictions.
Right, hitting all the pain points.
Exactly. It's about providing a safe, simple, versatile alternative that can, fundamentally shift prescribing habits and hopefully convert that big chunk, that 2/3 of the market still stuck on older, less optimal treatment.
Now, the market conversion, that's the core challenge, isn't it?
Yeah.
Let's widen the lens now and consider the broader industry analysis. The global dermatology market itself is growing strongly.
Oh, yeah, definitely.
Projections show it expanding from about $1.5 billion in 2025 to maybe $2.75 billion by 2034. That's nearly a 7% compound annual growth rate, CAGR.
Driven by aging populations, more awareness, new tech.
Right, and the specific markets ZORVE targets. They're
Oh.
huge. Psoriasis, atopic dermatitis, seborrheic dermatitis, all multi-billion-dollar markets individually with healthy growth rates themselves.
Yeah, the market sizes are substantial. Psoriasis is anywhere from $7 to maybe $12.07 in 2024, growing 3.9% CAGR depending on who you ask. Atopic dermatitis, $6.06 to $17.06, growing 8.9%. Sebderm, maybe $2.08, but growing faster, around 11% CAGR.
So the opportunity is there. But that leads us straight to the competitive landscape. Who are they up against?
Well, you could say Arcutis is fighting a kind of war on two fronts.
Okay.
Their biggest competitor, volume-wise, is still those deeply entrenched, often generic topical steroids. That's the legacy treatment they need to displace.
The main target for conversion.
Exactly. But they also face direct competition from other branded non-steroidal topicals. Think Pfizer's Eucrisa or Dermavant's Vitama.
Right. Other newer options.
And then for the more severe cases, you also have competition from systemic and biologic therapies. Things like BMS's Sotyktu, Dupixent from Sanofi Regeneron, AbbVie's Humira.
So it's a crowded field.
Very crowded. It's not just about beating one rival. It's about carving out a really definitive, defensible space.
You mentioned earlier the regulatory process in biopharma, FDA trials, manufacturing rules, now even new pricing legislation like the IRA. It's incredibly complex. How do these regulations act as both, well, a hurdle and maybe paradoxically a long-term advantage once you overcome them?
That's a really crucial point. The regulatory environment and the related barriers to entry are just formidable.
Yeah.
It starts with investigational new drug apps, INDs.
Yeah.
Then you have multi-phase clinical trials needing good clinical practices, GCP.
Yeah.
Then new drug applications, NDAs. And it doesn't stop there. Ongoing adherence to current good manufacturing practices, CGMP, pharmacovigilance.
It's a marathon.
It is. And it means immense R&D costs. We're talking hundreds of millions, often over a decade, for a single new drug. Plus, you need specialized scientific and clinical expertise, the ability to scale up manufacturing.
And then getting it paid for.
Absolutely critical. Achieving broad market access and favorable reimbursement through those powerful pharmacy benefit managers, the PBMs, that's a huge hurdle. These are the organizations deciding which drugs insurance plans cover.
So the barriers are high.
Extremely high. But once you clear them, as Arcutis has with ZORYVE, those very hurdles act as a substantial moat, protecting you from new entrants just popping up.
Okay, so given those formidable barriers in the competition, what specifically constitutes Arcutis' competitive advantage? What's their moat?
They've built their moat strategically. First, there's brand strength. ZORYVE becoming the #1 prescribed branded non-steroidal topical so quickly is significant. It's about building trust and loyalty with dermatologists.
Makes sense. Brand matters.
Second, while it's not a traditional manufacturing cost advantage, their strategic cost advantages are key. They've been very successful in negotiating with major PBMs and getting broad Medicaid coverage.
So access is good.
Very good. It makes ZORYVE affordable and widely available. That's a massive competitive differentiator, embedding it into the healthcare system in a way that's actually quite hard for competitors to replicate quickly.
Okay, brand and access. What else?
Third, for these chronic conditions, ZORYVE creates switching costs. Once doctors and patients see the benefits efficacy without the steroid side effects, they're less likely to switch back or try something else as readily. This progressive conversion from steroids, as they call it, fosters long-term loyalty.
Sticky customers, basically.
You could put it that way, yeah. Clinical stickiness.
And finally, you mentioned their unique assets.
Right. Their most unique asset is arguably the roflumilast molecule itself, that Swiss Army knife idea. Leveraging one molecule across multiple large indications is efficient.
R&D efficiency.
Exactly. Combine that with their unique dermatology development platform and their specialized team, and it allows for an R&D and commercial efficiency that's genuinely tough for others to match in this specific therapeutic area. It gives them an inherent advantage.
That provides a great bridge to Chapter 2, management evaluation, the architects of the commercial launch.
Yeah.
Because a great molecule needs great execution, right?
Absolutely. And the Arcutis executive team really does seem to have that big pharma DNA.
Meaning?
Well, look at the key players. Frank Watanabe, the CEO, he has direct, relevant experience from Amgen, specifically with the blockbuster Enbrel.
Okay, major drug launch experience.
Todd Edwards, the chief commercial officer, comes from AbbVie Think Humira, another massive commercial success story. Patrick Burnett, the chief medical officer, has leadership experience from Verrica and Sun Pharma.
Solid pharma backgrounds.
And Latha Varavan, the CFO, brings over 2 decades of biotech finance experience. This isn't just, an impressive list of names. It means they've likely seen the playbook for successful drug launches and large-scale ops firsthand. That significantly de-risks the execution part.
And speaking of execution and making tough calls, their management team just made a significant move. On the Q2 earnings call, they announced they're halting development of ARQ-255 for alopecia areata after seeing the Phase 1b data.
Yes, that was notable.
In an industry that's sometimes known for, let's say, throwing good money after bad, what does this specific decision signal to you about their approach, especially regarding capital allocation?
I think that's a really powerful signal of responsible capital stewardship. It shows they're disciplined, they're not afraid to cut programs even after investing in them if the data doesn't meet their criteria. That focus on maximizing shareholder value, not just pursuing science for science's sake, is critical.
So discipline. What about communication?
Their communication seems pretty solid, too. They publish an annual ESG report, which shows a commitment to broader responsibilities. And their earnings calls, like the recent one, tend to be direct, data-focused. That transparency builds trust.
Okay, so experienced leadership, disciplined decisions. Let's talk more about their capital allocation strategy.
It seems very clear. The priority is maximizing ZORYVE's value and funding their internal pipeline.
Right.
You see this reflected in their spending. Those significant SG&A expenses, selling, general, and administrative, hit $229.4 million in 2024. That's the heavy investment needed to support these big product launches.
Makes sense. Are they looking at M&A, buying other companies?
Doesn't seem like a primary focus. They appear to prefer organic growth, maybe supplemented by capital-light partnerships like that COA co-promotion deal we mentioned earlier.
Smart way to expand reach without huge upfront costs.
Exactly. And, as you'd expect for a company at this stage, pre-profitability, focused on growth, there are no dividends or share buybacks happening. All the capital is going back into the business.
Okay. And this investment strategy impacts their return on invested capital, ROIC.
For sure. Right now, their ROIC is negative, around Meganish 15.6%. But that's completely expected for a company investing so heavily in its commercial launch and R&D.
So the key is a future path.
Precisely. The critical factor is the trajectory. Management has explicitly guided towards reaching cash flow break-even sometime in 2026.
Okay.
And given their extremely high gross margins, we'll get to that, but they're around 88% once they do hit that profitability inflection point. A very significant portion of each new revenue dollar should drop straight to the bottom line. That's what should drive a strong positive ROIC in the future.
That 88% gross margin is definitely something to keep in mind. Let's dive into the numbers now with Chapter 3, Financial Analysis, Charting the Path to Profitability. Give us the snapshot.
Okay, as of market close on August 7th, 2025, the share price was $14.12. Market cap hovering around $1.71 billion.
Look.
The 52-week price range has been pretty wide, from $7.86 up to $17.75. There are about 119.91 million shares outstanding, and the beta is 1.84.
1.84 beta. So
Yes.
significantly more volatile than the overall market.
Yes, which is typical for a biotech company at this stage. Now, the real story in Arcutis' financials is that revenue growth. It's genuinely hypergrowth.
We saw that Q2 number, 164% year over year. What about the full year picture?
For the full year 2024, total revenue hit $196.5 million. That represents a staggering 471% increase over 2023.
471%.
Yeah, and as you said, that momentum clearly continued into Q2 2025 with $81.5 million in net product revenue, up 164% year over year, and a healthy 28% sequential increase from Q1.
Those figures really demonstrate that rapid market penetration and strong commercial execution we talked about.
No question, they're getting the drug out there and getting it prescribed.
Okay, but growth costs money. Let's look at profit margins. You mentioned that high gross margin.
Right, this is where it gets interesting. It's kind of a tale of two extremes right now. Their gross margin is, frankly, stellar at 88.39%.
88%.
Yeah.
That's huge for a pharma product.
It is. It's like a hidden gem in their financials. It means the ZORYVE product itself is highly profitable to actually make and sell. This gives them incredible financial flexibility and operating leverage once they scale past the launch costs.
Okay, so great gross margin. But the bottom line?
Yeah, the operating and net margins are currently deeply negative. They reported a net loss of $140.0 million in 2024. And that's simply because of those heavy upfront investments in the commercial launch sales force, marketing, and ongoing R&D.
Burning cash to fuel growth, which leads us to free cash flow generation.
Historically, yes, they've consumed significant cash to fund that growth. Building the commercial infrastructure, running trials, it all costs money.
But you mentioned an inflection point.
This is potentially huge news from the Q2 2025 report. They actually achieved a slightly positive operating cash flow of $325,000.
Just barely positive, but positive nonetheless.
Exactly. It might seem small, but that's a monumental signal. It hints that they might be turning the corner towards self-sustainability, and it really adds credibility to management's guidance for hitting cash flow break-even in 2026.
That's definitely a key milestone to watch. How about overall financial stability?
Well, they have consistent net losses, but as we've said, that's normal for a biopharma transitioning to commercial stage. The key trend is that those losses are narrowing quarter over quarter.
Okay, improving trend. What about debt?
They had $100 million in debt as of December 2024, giving them a debt-to-equity ratio greater than 1, so significant leverage. But it seems manageable given their cash position.
And short-term liquidity. Can they pay their bills?
Yeah, their short-term liquidity looks strong. The current ratio is between 3.2 and 3.55. That's supported by a healthy $191.1 million in cash and marketable securities at the end of Q2 2025.
Plenty of cushion for near-term operations.
Seems so. And again, no dividend, as you'd expect.
Okay, so putting it all together, how does this translate into valuation analysis? How is the market pricing this growth story versus the current losses?
Right. Since they're not yet profitable, the standard price to earnings, or PE ratio, is meaningless. It's negative.
So you look at sales.
Exactly. We look at the price to sales, or PS ratio. Based on recent revenue and the current market cap, it's approximately 7.32.
Is 7.32 high or low?
Well, for a company growing revenue at 164% year over year, a PS of around 7 could actually be seen as pretty reasonable, maybe even attractive, by growth-focused investor.
Okay, what about intrinsic value? Can we estimate that?
We can try using a discounted cash flow or DCF model, but it's crucial to remember this is more of an educational tool, especially for a company like this, because it's highly sensitive to the assumptions you make.
Understood. So what are the key assumptions we'd plug into a DCF for Arcutis?
You'd have to assume very high revenue growth in the near term, say 2025 through 2027, reflecting that ZORYVE ramp up. Then you'd taper that growth down significantly in the long term, maybe to just 2–3%, like a mature company rate.
Okay, growth assumptions. What about margins?
You'd project operating margins improving dramatically from deeply negative now, eventually reaching maybe 25–30% in the terminal phase, reflecting those high gross margins and operating leverage kicking in.
And the discount rate, reflecting the risk.
Definitely need a high discount rate here, given the stage and risks, maybe 10%, 11%, 12%, somewhere in that range, to account for the uncertainty.
Okay, so with those kinds of inputs, what does the DCF suggest?
Based on those assumptions, a reasonable base case scenario for Arcutis' intrinsic value might fall somewhere in the range of $18 to $25 per share. This assumes they achieve strong market penetration with ZORYVE, hit that 2026 profitability target, and have moderate success with their pipeline.
In the upside or downside scenarios?
A bull case could push the valuation above $30 per share. That would likely require dominant steroid conversion, really capturing a huge chunk of that market, faster profitability, and significant pipeline success beyond just ZORYVE.
Okay, and the bear case?
The bear case would probably put the value below $12 per share. This would happen if ZORYVE growth slows unexpectedly, competitive pressures really intensify, maybe the pipeline fails, or profitability gets pushed out significantly beyond 2026.
So, wrapping up the valuation picture.
The key takeaway is that the market, with the stock price at $14.12, seems to be pricing Arcutis somewhere between that bear case and the lower end of the base case. This implies there could be significant upside if management executes strongly and hits those base case assumptions.
Okay, that's a fantastic overview of the financials and valuation context. That concludes part 1.
All right.
Now for part 2, let's shift gears and look outwards. We'll start with chapter 4, market sentiment, Wall Street's view versus the shorts. And this is where things get really interesting because this company, as we said, sparks some fiercely divided opinions.
It really does. It's a striking contrast. On one hand, you have the Wall Street analyst community. Their consensus view is, well, overwhelmingly positive.
How positive?
Of the 11 analysts covering the stock that we looked at, 91% rated either buy or strong buy. It's split pretty evenly, about 45% strong buy, 45% buy.
So very few holds or sells from the analysts. What about price targets?
The average price target sits around $21.25 compared to that $14.12 closing price on August 7th. That suggests about 38% upside potential, according to the analysts.
And we see targets from big firms.
Yeah, firms like Needham, $22, Mizuho, $21, H.C. Wainwright, $19, Goldman Sachs, $18, Jefferies, $19. They're all generally in that higher range, reflecting optimism about the ZORYVE launch and growth trajectory.
The general news flow reflects this.
Mostly, yes. The media tone, especially after those recent earnings beats, has been very positive. Lots of focus on the triple-digit growth, the rapid ZORYVE uptake, supported by all that positive clinical data and the FDA approvals.
Okay, so analysts are bullish. News flow is positive. But you mentioned divided opinions. Where's the skepticism coming from?
It shows up very clearly in the market indicators, specifically the short interest. Despite all that analyst optimism, the short interest in Arcutis is, frankly, extraordinarily high.
How high are we talking?
As of the latest data, there were 17.27 million shares held short. That represents a staggering 20% of the company's entire float.
20% short interest. That's huge. That's a massive bet against the stock succeeding.
It absolutely is. It shows a significant portion of the market is deeply skeptical about the bull case, likely focusing on the risks, competition, cash burn, valuation.
What about days to cover? How long would it take shorts to buy back shares?
Based on recent average trading volume, the days to cover is approximately 10 days. That's quite high.
And what does that imply?
It implies the potential for a significant short squeeze. If some positive catalyst emerges, maybe another huge earnings beat or great pipeline news, the short sellers might rush to buy back shares to cover their positions all at once. That intense buying pressure could cause a very rapid spike in the stock price.
So high short interest creates volatility risk, but also squeeze potential.
Yeah.
What are the technicals saying? Moving averages.
It looks like a technical battleground right now. The stock is trading just slightly below its 50-day simple moving average, which is around $14.80, and it's hovering right in the vicinity of its 200-day SMA, which is around $14.56, or maybe closer to $13.10, depending on the exact calculation method.
So right at key technical levels.
Exactly. It indicates the stock is at a technical crossroads. A decisive move above or below these averages could signal its next significant direction. Buyers and sellers are really fighting it out here.
Fascinating divergence between analyst sentiment and market positioning. Let's move on to Chapter 5. Ownership structure. Who's betting on Arcutis? It's always revealing to see who actually holds the shares.
Yeah, looking at the ownership is insightful. Institutional investors think mutual funds, hedge funds, pension funds own over 105% of the total shares outstanding.
Wait, over 100%? How does that work?
It sounds strange, but it can happen. It's usually due to short selling. When shares are loaned out to short sellers, they can sometimes be counted twice in the ownership data by the original lender and potentially by the institution that bought the borrowed share. So 100% indicates very high institutional interest and significant shorting activity.
Got it. Who are the big institutional holders?
Some of the key names include Savretta Capital Management, Jennison Associates, Rubric Capital Management, BlackRock, and Frazier Life Sciences Management. These are sophisticated investors holding large positions.
So smart money has conviction here. Have they been buying or selling recently?
The recent activity seems a bit mixed, actually. While the overall ownership is high, some firms like Jennison and Polar Capital trimmed their stakes somewhat in the latest reporting period. Could be profit-taking after the recent run, could be rebalancing. Hard to say for sure.
Okay, what about insiders, management and directors?
Insider activity has been pretty frequent. Over the last 12 months, there were 78 total trades reported, 29 buys and 49 sells.
More sells than buys. Is that a red flag?
Not necessarily. You have to look closer. Many of the executive sales, like those from CEO Frank Watanabe or CMO Patrick Burnett, appear to be part of prearranged 10b5-1 trading plans.
Ah, the automatic selling plans.
Right. Executives set these up in advance to sell shares periodically for diversification or tax purposes. They're generally not seen as signals about the company's near-term outlook, as the sales happen automatically based on preset conditions.
So executive sales might not mean much. What about buys?
This is where it gets interesting. Discretionary open market purchases by insiders are often seen as a much more powerful signal.
Why?
Because it's an insider using their own money, making a conscious decision to increase their stake at the current market price. It signals genuine confidence.
And have there been any of that at Arcutis?
Yes. Notably, director Patrick J. Heron has made multiple open market purchases over the past year or so. That's a tangible vote of confidence from someone with deep insight into the company.
That is a strong signal. Now, you mentioned high institutional ownership. Is the ownership concentrated?
It is quite concentrated, yes.
Yeah.
The top 10 institutional holders control a significant portion of the company.
And that's a double-edged sword, isn't it?
It really is. On one hand, high concentration shows deep conviction from these sophisticated investors who've presumably done extensive due diligence. That's positive.
The downside.
The downside is a sort of key man risk at the fund level. If one or two of these very large holders decide to exit their position for whatever reason, maybe a change in their fund strategy or locking in gains, it could create significant selling pressure on the stock regardless of the company's fundamentals at that moment.
Right. Liquidity risk if a big fish wants out.
Right.
Okay, let's pivot now to Chapter 6, Risk Assessment, a SWOT analysis. Let's systematically break down the strengths, weaknesses, opportunities, and threats facing Arcutis.
Sounds good. Starting with strengths, the internal positives.
What stands out?
First and foremost, the compelling product profile of ZORYVE. Its demonstrated efficacy, safety profile, and versatility across multiple conditions is a core strength. Second, their proven commercial execution so far, that rapid market uptake and strong revenue growth shows they know how to launch a drug.
Okay, product and execution.
Third, that experienced management team we discussed with their deep, big pharma background. And fourth, their success in achieving strong market access, getting broad, favorable reimbursement is a huge asset.
Those are solid strengths. Now, what about the internal negatives, the weaknesses?
The most glaring weakness is definitely product concentration risk. They are overwhelmingly reliant on the ZORYVE franchise right now. If anything unexpected happened with ZORYVE, new competition, safety issues, it would hit them very hard.
Legal product risk.
Exactly. Second, the ongoing cash burn. They're not yet profitable and are still consuming cash to fund operations and growth. Third, related to that, are the high operating expenses, especially the SG&A needed to fuel the launch. It's necessary, but it weighs on the bottom line currently.
Understood. Now let's look externally. What are the opportunities Arcutis could capitalize on?
The biggest one, by far, is that massive steroid conversion market we keep mentioning. Remember, roughly 70% of the topical market still uses steroids. Converting even a fraction of that represents enormous growth potential for ZORYVE.
Huge addressable market still untapped.
Absolutely. Second is pipeline expansion. They have other assets in development, like ARQ-234. Future growth could come from these if they're successful. Third, international growth, leveraging those existing partnerships in Japan and China and potentially expanding further. And fourth, potential label expansions for ZORYVE, maybe into younger pediatric populations, which would broaden its use even more.
Lots of avenues for growth. But there are always external threats. What looms large for Arcutis?
Intense competition is a constant threat. From generic steroids, other branded topicals like Vitama and Eucrisa, and even those systemic and biologic therapies for more severe disease. It's a tough neighborhood.
Competition. Okay. What else?
Payer pushback is always a risk. Increased pricing pressure from PBMs or policy changes like the Inflation Reduction Act impacting drug pricing down the line. Then there are the broader macroeconomic headwinds.
Like inflation and interest rates.
Exactly. Inflation could increase their operating costs and squeeze those margins, even the gross margin eventually. Rising interest rates increase the discount rate used in valuations, putting pressure on the stock price, and also make future borrowing more expensive.
And you mentioned one specific, perhaps underappreciated risk earlier. Tariffs.
Yes. This is a critical one to highlight, I think, especially given some of the geopolitical rhetoric we've seen around potential U.S.-imposed tariffs on imported goods, including pharmaceutical components, maybe starting as early as 2025, based on some policy discussions.
How would that impact Arcutis specifically?
It could directly attack that stellar 88% gross margin, which is a cornerstone of their path to profitability. If key ingredients or components they rely on face tariffs, it would immediately increase their cost of goods sold.
Undermining a key strength.
Precisely. It would increase costs, potentially delay their break-even timeline, and negatively impact their valuation. It shifts a significant part of the risk profile from the clinical and commercial side to the geopolitical and supply chain domain. It's a really critical and maybe underappreciated external threat for investors to monitor.
That's a very potent point and definitely something for listeners to track. Okay, we've covered a lot of ground. Let's bring it all together now in Chapter 7, Conclusion.
All right, let's synthesize the findings. The bull case for Arcutis really rests on a few key pillars. You have what appears to be a best-in-class non-steroidal product in ZORYVE, targeting a massive market that's genuinely ripe for disruption.
Right, the steroid conversion opportunity.
Exactly. This is being driven by a seasoned management team that has demonstrated near-flawless commercial execution so far. The evidence is that explosive revenue growth, those fantastic 88% gross margins promising future profitability, the broad payer access they've secured, and that clear line of sight management has provided towards cash flow, break-even, and profitability, likely in 2026.
Plus institutional conviction and pipeline potential.
Correct. Add in the conviction shown by major institutional investors and the potential for future growth from their pipeline. It paints a compelling picture of a company executing well in a large market.
But then there's the bear case. What are the main counterarguments rooted in risk and valuation skepticism?
The bear case, which is clearly reflected in that very high 20.11% short interest, focuses on the risks. First, that dangerous dependence on a single product franchise, ZORYVE. Second, the ongoing cash burn and uncertainty about when they'll truly achieve sustainable profitability given the high launch costs.
Skepticism about the timeline.
Yes. And third, the significant external threats. Intense competition is not going away. Pricing pressure from payers is a constant worry, and those critical macroeconomic and geopolitical risks, particularly the potential impact of tariffs on their cost structure and profitability, loom large.
So bulls focus on execution and opportunity, bears focus on risk and timing.
Yeah.
Where does valuation fit in?
Well, as we discussed, our educational DCF model generated an estimated intrinsic value range, a base case, of $18 to $25 per share.
Okay, and how does the current price compare?
With Arcutis' share price at $14.12 as of August 8th, 2025, it's currently trading below the low end of that base case intrinsic value range.
Suggesting potential undervaluation if they execute.
Precisely. It suggests potential undervaluation if management continues to execute effectively and hits those milestones, particularly the 2026 profitability target. However, that if is significant. That potential upside must be weighed against the very real, tangible risks of product concentration, intense competition, ongoing cash burn, and those external threats like tariffs risks that are clearly being priced in to some extent by that high short interest.
So it really comes down to which narrative plays out.
I think that's the perfect way to frame it. This leads us to the final provocative thought for you, our listener. Which narrative will ultimately prove more prescient in determining Arcutis's future trajectory? Will it be the bull's story of successful disruption and strong execution in a large market? Or will it be the bear's story, emphasizing the risks of competition, cash burn, and particularly those external macroeconomic and geopolitical factors like tariffs?
A fascinating question indeed, and one investors will be watching closely. That's something for you to consider. Thank you for joining us on this deep dive into Arcutis Biotherapeutics.
It's been a great discussion.
We really encourage you to weigh the various perspectives we've discussed today, the bull case, the bear case, the risks, the opportunities, as you form your own informed opinion.
Do your own homework.
Absolutely. And if you enjoyed this deep dive and found it valuable, please do like and subscribe to the Stock Analytics AI YouTube channel.
It helps us a lot.
It really does. And remember, members paying just €4.99 a month get priority deep dives on tickers they request. Plus, over the next few months, we're undertaking a huge project covering all of the S&P 500 stocks, and members will get exclusive priority access to those deep dives.
That's a massive undertaking.
It is. And if you just want a one-off deep dive on a specific stock you're interested in, you can always drop us a super thanks on YouTube, and we'll do our best to cover it.
Great options for listeners.
Finally, the important disclaimer. This analysis was generated by an AI system and is intended for educational purposes only. It should definitely not be considered financial advice.
Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Thanks again for listening to The Deep Dive.